Hey everyone, welcome back to the channel. Today we are diving deeper into revenue recognition, specifically step 3 of the 5-step revenue recognition process, determining the transaction price. If you are studying accounting, prepping for the CPA exam, or just trying to understand ASC 606 a little better, this video is for you. So let's jump right in. What is the transaction price? The transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring goods or services. The transaction price in a contract is often easily determined because the customer agrees to pay a fixed amount to the company over a short period of time. However, at other times, things become a bit more complicated. Companies must consider variable consideration, non-cash consideration, time value of money, consideration paid or payable to the customer. Today, we are focusing on the big one, variable consideration. In these cases, the company estimates the amount of variable consideration it will receive from the contract to determine the amount of revenue to recognize. To achieve this, they employ one of two methods. First, expected value method, a probability-weighted average of possible outcomes. This method is most effective when a company has numerous similar contracts. Second, most likely amount method. This is simply the single most likely outcome. It's usually used when the contract has only two possible results, like bonus or no bonus, or discount or no discount. Companies select between these two methods based on which approach better predicts the amount of consideration to which a company is entitled. Note that a company only allocates variable consideration if it is reasonably assured that it will be entitled to that amount. That means they must have experience with similar contracts, and it must be highly probable that no significant revenue reversal will occur. If not, revenue recognition is constrained. In other words, you don't recognize the variable portion yet. Let's walk through an example using Range and Farm Supplies Company, a distributor of range and farm equipment. Among other products, Range and Farm Supplies sells mini trenchers with a standalone selling price, or SSP, of $3,600 and a cost of $2,000. Now, let's look at a sale involving variable consideration. On August 10, 2025, Range and Farm Supplies sells 16 mini trenchers to a farm co-op. There's a 4% volume discount, but the discount only applies if the co-op increases its purchases by 15% over the prior year. But here's the thing. Farm sales are flat. It's highly uncertain that the benchmark will be met. So, does Range and Farm Supplies apply the discount now? Nope, because it's not probable that the customer will achieve the required increase. The company doesn't reduce revenue. Before we record the entry, let's briefly review the rules of debit and credit. Accounts receivable and inventory are asset accounts and are increased by debit and decreased by credit. Cost of goods sold is also increased by debit and decreased by credit. Revenue is increased by credit and decreased by debit. If you need a refresher, watch my video Rules of Debit and Credit. I am posting the link here and in the description below. To record revenue, we debit or increase accounts receivable by $57,600, which is 16 multiplied by the standalone selling price of $3,600, and credit or increase sales revenue by $57,600. To record the cost of goods sold, we debit or increase cost of goods sold by $32,000, which is 16 multiplied by 2,000, and credit or decrease inventory by $32,000. Note that there is no adjustment for the volume discount because it is not probable that the customer will reach the benchmark. And that's how companies determine the transaction price under ASC 606, especially when variable consideration is involved. If this video helped clarify the concept, hit that like button, subscribe for more accounting breakdowns, and drop your questions in the comments below. Thanks for watching, and I will see you in the next video.